Hi, my name is Joey Criscolo here at Fairway Independent Mortgage, and one of the things I have no greater joy in is seeing a first-time home buyer get into the home of their dreams. Now, I know it can be a very overwhelming and daunting task at first, but I want to be here to break things down for you and help guide you through the process as smooth as possible. First thing you have to know when you are purchasing a home is the pre-approval process. Why it's important to get pre-approved is because you do not want to waste your time or your realtor's time. You want to know exactly what you're shopping for and the price point that you want. Sometimes you may be pre-approved for more than you want to, but if you don't want a high monthly mortgage, there's no point in shopping that high. Now, there are two types of pre-approvals, a pre-approval or an underwritten approval. What an underwritten approval entails is gathering all the documents up front, just like a pre-approval, but we stick it in front of an underwriter, and so they do an overview and a review of your whole entire file and verify everything. I would love to give you a loan for $400,000, but the underwriter has the final say, of course. Once you get underwritten approved, this will allow you to then put offers in on a home and be more competitive if there are multiple offers on a home. This will also allow us to do a quick close within 14 days and allow you to get into your home of your dreams faster. One of the main questions I get a lot is all-in cost. What does the all-in cost entail? Down payment and closing cost. Let's break down down payment for a minute. The minimum down payment for an FHA loan is 3.5%. For a first-time home buyer, if you go conventional, it's 3%, or typically 5% after that. That is separate from your closing costs. Closing costs can be broken down in a few different ways. What I like to encourage you with when you're saving money is to have your all-in cash to close. On closing costs, it can be anywhere from 2 to 3% of the sales price of the home. Now let's break down what closing costs are just a little bit. You're gonna have an origination fee from the bank. Second is third-party fees. Title fees, also prepaids. Prepaids are taxes and insurance which your mortgage company will collect up front. We typically collect a year's worth of homeowner's insurance up front and 3 months property taxes, so we pay those through your escrow account or your mortgage. Let's break down a little more about the down payment. If you want to put down 20% on the down payment, you have no PMI or private mortgage insurance. Typically what private mortgage insurance is it's insurance for the bank if you as a borrower were to default on your home. So that gives the bank insurance. Now, if you put down more than 20%, there is no private mortgage insurance. You do have the ability to lose the private mortgage insurance once you gain 20% equity in your home if you do not put down 20% to start. When wanting to put down 20% on your home, that could make the difference of about $200 to $300 in the price of your mortgage each month. Now, typically, if you don't have the 20%, but you do have great credit score, that will allow your private mortgage insurance cost to be lower. Let's talk about rates for a second. Everybody always wants to know what the current interest rate is. Current interest rate can change sometimes by the day. The rate is dependent upon the bond market and where that goes. Now, you cannot lock in an interest rate until you get into contract, so you are subject to the rates changing every single day. Now, there are a few main factors that go into interest rates. One is your credit score. Another is loan to value and how much you're putting down. All of that is factored into the interest rate when you are purchasing a home and when you do have the ability to lock. A lot of people throw out the term seller credit today. Seller credit can be very beneficial to you as a buyer. There are many things you can do with seller credit, but two of the top things that you can do is buy down your interest rate lower and also apply it toward your all-in cash to close. Seller credit is an incentive for you as the buyer to purchase their home. What they do is they will throw out a number for you and contribute that towards your all-in closing cost. Seller credit can be capped depending upon what type of loan you get. FHA loans, you're capped at 6% of the sales price of your home. If you're going conventional, it depends what your down payment is, but there is a certain max seller credit cap that the sellers can contribute. In today's market, seller credit is still pretty prevalent. For example, I have seen as low as 0.5% towards seller credit, all the way up until 4.5% to 5% of seller credit, helping the all-in closing costs for the borrower to be extremely low and get into their home of their dreams. Sometimes you as a buyer may not have all of your funds for down payment. That's why we have down payment assistance programs that are set by the state of Nevada. There are about 2 to 3 different programs that you can utilize towards your down payment and or closing costs if you have extra money left over. A lot of people ask me about down payment assistance and how it can be beneficial or how they can qualify for it. I had a borrower previously who was interested in down payment assistance, and they didn't have enough for the down payment, so we explored some different options. What we were able to get them is a 4% grant that is set by the state of Nevada. That then allowed them to have their whole down payment covered and 0.5% of their closing costs. They came into the table with a lot less money out of pocket because of the down payment assistance program. Now, there are a few different guidelines and rules and regulations that the state does set, so we need to make sure that you are qualified and everything is dialed in. If you're thinking that you need down payment assistance, please give me a call. I would love to sit down and see what program benefits you to save you the most possible when shopping for a home. Let's talk about debt to income ratio. That is one of the main things that we look at as lenders in order to qualify you. What does debt to income ratio entail? A debt to income ratio entails taking your gross monthly income and dividing it by your liabilities and your proposed monthly payment. Depending upon the specific program, we can see which one works best for you and calculate where your debt to income ratio is to get you into the best program possible. So what does this mean to you as you're looking and analyzing your own current financial situation? Well, you need to do obviously what's comfortable and best for you, but also, how can you start off by seeing what your debt to income ratio is and getting some rough numbers? What you first want to do is take your minimum monthly payment that you owe on your credit cards, not your overall balance. Take any auto payments that you may have or any other personal loans. Add those together. Then what you want to do is take a proposed monthly payment, add that to your liabilities, and divide by your gross monthly income. That will give you a better idea and understanding of where your budget is and what you can afford moving forward. The many conversations I have every single day with first-time home buyers is something that I love to do, and seeing you guys achieve your goals and getting into the home of your dreams. If you have any questions at all or want to dig a little deeper into seeing how close you are to getting into a home, please see my information below. Would love to talk to you.